Good afternoon. I am assigned to report about capital structure. This recorded discussion covers the following subtopics: the concept of capital structure, the definitions of capital structure, the importance of designing a proper capital structure, the debt equity ratio, and the factors that affect capital structure. The concept of capital structure. The relative proportion of various sources of funds used in a business is termed as financial structure. When we invest into a certain business, it is always a problem, a question on where are we going to get funds to finance our business. And we consider borrowing money from financial institutions like banks and cooperatives, and as well as we consider financing the business from our own savings. Yeah. These practices or these processes is called financial structure, because we try to source out funds to come up with our dream business. Yan. But for an established business, it has to consider the funds, or it has to consider long-term financing, which dito na pumapasok yung concept ng capital structure. And it comprises, the capital structure of a company comprises the debt and the equity of the company, which is equal to the assets. Okay? Capital structure is a part of financial structure. It is the proportion of various long-term sources of financing. Okay? And it is made up of debt and equity securities that comprise a firm's financing its assets. And these sources, this debt and equity securities include the following. It could be a long-term debt, preferred stock, net worth, or bonds. Under din yun ng long-term debt. Yan. Long-term debt are bonds, debentures, term loans, or in small firms, mortgages on buildings. Okay. For debentures, these are long-term security yielding to a fixed rate of interest, meaning hindi nagbabago yung rate charge on a certain liability. Okay? Yung bonds naman, they are considered as fixed income instrument, usually in the form of like coupons or certificates. Ganun. And under equity are the preferred stock and the net worth. The preferred stock are the shares of a company's stock with dividends that are paid out to shareholders before common stock dividends are issued. On the other hand, net worth is the value of the assets a person or corporation owns. So, itong mga long-term debt, preferred stock, net worth are considered the sources of fund of the business. I cited 3 definitions of capital structure from different authors. Capital structure is the mix of the long-term sources of funds used by a firm. It is made up of debt and equity securities and refers to the permanent financing of the firm. It is composed of long-term debt, preference share capital, and shareholders' funds, the one I just discussed in the previous slide. It is considered as permanent financing because the equity and the debt of the company is equal to the asset, of the company. So the debt and equity should exist in a certain company because it is already the company's capital structure. Okay. According to Kuhn and Company, capital structure is balancing the array of funds sources in a proper manner, in relative magnitude or in proportions. This definition emphasizes that capital structure is not just a simple decision for a company. In order for a company to, because capital structure is a policy or a scheme na ginagamit ng mga companies, in order to avoid the negative consequences of financing the company through debt and equity, there should be a proper proportion of the two, which I am going to discuss further later on. While according to P. Chandra, capital structure is essentially concerned with how the firm decides to divide its cash flows into 2 broad components: a fixed component that is earmarked to meet the obligations towards debt, capital, and a residual component that belongs to equity shareholders. Now, it is a question if capital structure is a decision of an enterprise. Definitely, it is. Capital structure is a decision about the proportion among this debt and equity securities in the total capital that will remain invested in a business over a long period of time. This is the this idea about capital structure further, combines the definition of Kyon and Chandra that capital structure is a decision of the firm, and it needs the equity and the total debt of an enterprise need to be there should be a proper proportion in deciding to about financing the business through debt and equity. Given the idea that the optimum proportion of debt and equity should be considered in designing a capital structure, it is typically expressed as a debt to equity or debt to capital ratio. The need for optimum proportion of debt and equity. Decisions relating to financing the assets of a firm are very crucial in every business, and the finance manager is often caught in the dilemma of what the optimum proportion of debt and equity should be. As a general rule, there should be a proper mix of debt and equity capital in financing the firm's assets. And the debt the debt and equity ratio is represented, calculated through this formula. Debt to equity ratio is equal to total liabilities of the company, or the total debt of the company, divided by the total equity. The numerator consists of the total current and long-term liabilities of the company, while the denominator consists of the total stockholders' equity, including the preferred stock. Let us take this as an example in computing for a debt-equity ratio. JJ Mont Incorporated, for example, has a total debt of $20 million. That comprises a short-term debt of $5 million and a long-term debt of $15 million. While total shareholders' equity amounting to $15 million. Yan, galing po sa common equity, which is $1 million, preferred equity or the preferred stock, $500,000, additional paid in capital, $9 million, and retained earnings amounting to $4,500 million. Yan. To compute for the debt equity ratio, let us use the formula. Okay. Total liabilities or total debt is $20 million divided by the total shareholders' equity, $15 million. So 20 million divided by $15 million is equal to $1.2 33, or in percentage 133. With this example, a debt to equity ratio of 1.33 means the company uses $1.33 in debt for every $1 of equity. Debt level is 133% of equity. A ratio of 1 means that investors and creditors equally contribute to the assets of the business. A more financially stable company usually has a lower debt to equity ratio. The question is, what is the ideal debt to equity ratio for a company? The ideal debt to equity ratio for a company will tend to vary widely by industry. It depends. But the general consensus is that it should not be above a level of 2.0 or 200%, while some very large companies in fixed asset heavy industries may have ratios higher than 2. These are exception rather than the rule. In our previous example, the debt to equity ratio is 1.33. So it is lower than the preferred debt to equity ratio, which is 2.0. So for this example, JJ Mont Incorporated, with this example, with the debt and equity ratio, I can say that, or we can say that, in terms of stability, JJ and Mont Incorporated has a lower, is financially stable. Basta in terms of debt to equity ratio, because it is lower than the preferred debt to equity ratio, which is 2.0. Another example, okay, from CFI, we have total debt is $163,000 and a total shareholders equity amounting to $37,000. To compute for the debt to equity ratio, let us divide the total debt of $163,000 by the shareholders equity amounting to $37,000, and the result will be 4.41 or 441%. Kapag titingnan po natin doon sa ideal or preferred debt to equity ratio, it exceeds the 200%. So comparing the two examples for JJ Mont Incorporated and the example from the CFI, mas stable ang JJ Mont Incorporated, the first example, it is more financially stable than this one, based on DE ratio. It has also to be noted that the debt to equity ratio is associated with risk. or financial risk. A higher ratio suggests higher risk and that the company is financing its growth with debt. Okay, ibig sabihin parang yung sa capital structure kung titingnan natin, mas mataas yung galing sa utang, parang ganon. So, and it is not risky in the part of the company. Yan. Setting capital structure involves trade-off between risk and return. Using more debt will raise the risk borne by stockholders. Yun. Kasi kapag mas mataas yung debt sa, hindi siya debt utang. Okay? Pag mas mataas yung debt sa capital structure, it will be a problem in the part of stockholders. Parang they are investing to a company na it is parang kailangan pag gusto talaga nilang ituloy yung investment nila doon sa isang company, sa company na yon, then they have to take the risk. Yun. However, using more debt generally increases the expected return on equity. Yun naman yung kagandahang part ng pagkakaroon ng debt sa total sa capital structure ng isang company. Bakit? Ano ba yung return on equity na sinasabi natin? The return on equity is another measure of profitability of the company in terms of equity. And it is taken by dividing the annual net income of the company by the average shareholders' equity. So, with this, we seek to find, or financial managers seek to find the optimal structure that strikes a balance between risk and return so as to maximize the stock price. Going back to return on equity. By taking on debt, company increases its assets. But since equity equals assets minus total debt, a company decreases its equity by increasing debt. Okay? Kapag ang company mangungutang, for example, sa isang financial institution, tataas yung assets. Pero dahil equity is equal to assets minus the total debt or yung inutang niya sa yung utang, a company decreases its equity by increasing debt. And when debt increases, mag-decrease naman yung equity. And since equity is the return on equity's denominator, ROE in turn gets a boost. Again, when debt increases, equity shrinks. Yon. Ano ba ang kagandahan kapag bumaba yung equity because of debt? On return on equity, it is important to result into a higher return on equity. Pag titingnan natin dito sa formula, ROE is calculated through the annual net income divided by the average equity of the company. If the average equity of the company, like what I was saying a while back, pag mababa yung equity, may tendency rin na mataas yung ROE. Okay? To illustrate, let us take this as an example. Natividad Company's 2019 income statement puts its net income at $3.822 billion. On the balance sheet, total stockholders' equity for the year 2019 totals $25.268 billion, while in 2018 it was $814 billion. Okay, using the formula, ROE is equals to net income divided by shareholders' equity. Let us compute for the return on equity of Natividad Company. Okay, first step is to get the average stockholders' equity. So, for 2019, $25.268 billion plus for 2018, $6.814 billion divided by 2 to get the average. It is equal to $16.041 billion. So we have the average stockholders' equity. We will use to get the ROE. Let us divide the net income amounting to 3.822 by the average stockholders' equity, 16.041, and we can come up with 0.238 or 0.24, equivalent to 24%. Yan. This is the to calculate return on equity, average shareholders' equity for 2019 and 2018 should be first computed, and divide net income for 2019, $3.822 billion by that average. Okay, you will arrive at a return on equity of 0.24 or 24%. This tells that Natividad Company for the year 2019 generated that is 24% profit on every dollar invested by the shareholders. So, sa bawat $1 na ininvest ng shareholder, that is equivalent to 23% profit. And the higher return on equity, the high ROE rather represents a more stable financial, a more stable company in terms of return on equity. So the risk associated with the return on equity is that if the ROE is too low, it means that the shareholders of the company are investing on a company with parang delikado in terms of profitability. Yun. So why does debt capital matter? Okay? A business that ignores debt financing entirely may be neglecting important growth opportunities. The benefit of debt capital is that it allows businesses to leverage a small amount of money into a much larger sum and repay it over time. This allows businesses to fund expansion projects more quickly than might otherwise be possible, theoretically increasing profits at an increased rate. As the business continues its operation, may mga circumstances wherein the firm requires a higher amount of fund, okay, for a certain operation. So this is why debt capital matters, okay, to finance its projects or operations. Kasi a company kasi hindi rin pwede na laging magde-depend lang sa equity. Okay? A company that does not make use of leveraging potential of debt financing may be doing a disservice to the ownership and its shareholders by limiting the ability of the company to generate maximum profits. The interest paid on debt is also typically tax deductible for the company, while equity capital is not. Debt capital also usually carries a lower cost of capital than equity. Here are the 6 importance of designing a proper capital structure. The first is value maximization. Capital structure maximizes the market value of a firm. For example, in a firm having a properly designed capital structure, the aggregate value of the claims and ownership interests of the shareholders are maximized. Next is the cost minimization. Capital structure minimizes the firm's cost of capital or cost of financing. By determining a proper mix of fund sources, a firm can keep the overall cost of capital to the lowest. The third is the increase in share price. Capital structure maximizes the company's market price of share by increasing earnings per share of the ordinary shareholders. And it also increases dividend receipt of the shareholder. The fourth is investment opportunity. Capital structure increases the ability of the company to find new wealth creating investment opportunities. With proper capital gearing, it also increases the confidence of suppliers of debt. Yan. And growth of the country. Capital structure increases the country's rate of investment and growth by increasing the firm's opportunity to engage in future wealth-creating investments. And the last is the patterns of capital structures. There are also factors that affect capital structure, or these are factors that affect the financial manager's decision on setting a good capital structure for their companies. The first is size of the company. Companies may have to rely on the founders' money, but as they grow, they will be eligible for long-term financing because larger companies are considered less risky by investors. Okay? Usually kasi kapag maliit pa yung negosyo or kasisimula pa lang, investors would say no to them kasi parang risky pa. Okay? Parang questionable pa sa kanila kung saan mapupunta yung pera nila once they invest in that small company. Yun. And this affects the capital structure of the company. Kasi kapag maliit lang na company, mahihirapan siyang maghanap ng institutions that would, or investors that would invest doon sa company nila for long-term purposes. Yun. So, it affects the capital structure of the company. At dahil doon, they would only rely to the equity or the money na isi-share ng may-ari ng business. Yun. From personal savings na lang, doon sila magre-rely. Yan. The next is nature of business. If the business is a monopoly, you can go for debentures because your sales can give you adequate profits to pay your debts easily or pay dividends. The third is the regularity of earnings. A firm with large and stable incomes may incur more debt in its capital structure, unlike the one that is unstable. Yan. Fourth, conditions of money markets. Okay, the money markets are may refer to the organized exchange market of the company. Yun. Because capital markets are always changing. Okay, the company doesn't want to company shares during a bear market or kapag nagde-decline yung presyo ng securities. Okay? Fifth, government policy. This is important to consider for a company dreaming for a good capital structure, because a change in lending policy imposed by the government may affect the business. For example, may government agency, for example, this for securities markets, we have the Securities and Exchange Commission that regulates the securities markets. If, for example, they impose a change in lending policy that may increase cost of borrowing, that may affect the capital structure of a company, and that must be considered. Next is the cost of float. The cost of floating equity is much higher than that of floating debt. This may influence the finance manager to take debt financing, the cheaper option. And lastly, debt equity ratio. As stated, debt is a liability whose interest has to be paid irrespective of earnings. High debt in a capital structure is risky. Yun, tulad nung as I was saying a while back, high debt in capital structure is risky and may be a problem in adverse times. So it should be a consideration for financial managers to prepare a good capital structure by considering the proportion of debt and equity. Yeah. So next, our favorite, end of presentation. That concludes the factors of affecting capital structure concludes my recorded discussion. Thank you for listening.